A mixed jobs report mostly pleases investors. Alexander Morris of FM Investments joins us. Alex, non-farm payrolls added 50,000 jobs in the month of December. That was less than what economists had expected. Yet the unemployment rate edged down to 4.4%. What's your takeaway from the report?
We had expected, we being consensus of a lot of economists, about 70,000 jobs. But importantly, the range was from about 22,000 up to about 132,000 jobs. So this number still fell within the range of reasonable possibility. And it is a little confusing that we have unemployment sort of ticking down, which is generally good, fewer jobs, it seems generally bad. But there's a third statistic that's often quoted, and we think that's probably the most important. 3.8% year-on-year wage growth. Because ultimately, you can have fewer jobs, you can have different unemployment numbers. There's seasonality that goes into that. There's a lot of math that changes. But if wages are going up, that's a good sign that inflation is going to follow. And of course, inflation puts the Fed right in the crosshairs of what do we do? Try to create more jobs or try to fight the inflation that's resulting from it?
Manufacturing jobs in December continued an 8-month skid that began when President Trump rolled out the tariffs that he said would lead to a resurgence in factory jobs. So, what's the disconnect here?
It's time. It takes a long time to build a new factory, hire tens of thousands of people, train them, and start a factory producing things. Some factories never shut down because even a few minute shutdown takes weeks of startup time and making processes start working again. So although it was very pleasing to hear from the Rose Garden the resurgence of jobs that would come to America from manufacturing and this dignity restored to the Midwestern manufacturer, it's going to take years of really disciplined principal investment for that to come to fruition. We've heard lots of big companies saying they're reinvesting in America who actually are starting to move some labor back and are breaking ground on factories. But like anyone who's done a home renovation or even tried to schedule getting their car in to be repaired, those things don't happen overnight.
Trump late Thursday posted jobs data that was not supposed to be released until this morning, specifically showing more than 650,000 private sector jobs had been added since January, and government jobs dropped by more than 180,000. What do you make of the president doing that?
I think anyone who believed that data wasn't being shared with the executive branch was somewhat dreaming, and you just had that dream recognized as just that. The president does have access to lots of data. You do require security clearance to see some of it. When the BLS shut down, the problem wasn't that we didn't know what the numbers were. It was simply that we didn't have the people showing up to the office to put it together. But it does seem unnecessary foolhardy of the president to lead with that data ahead of informational timelines that investors are used to. I don't know that there was any inherent unfairness of it. It did seem to be somewhat premeditated that after the markets was closed, had been closed for a while, but practically violating that sort of time-honored tradition of embargoing the information, releasing it at the same time to everyone in the public seems like a bad idea. That precedent has existed for a very, very long time, and it's served us all quite well.
You touched on the Fed earlier. So, how does today's jobs report factor into Fed policy going forward?
Certainly another data point they've been looking for, but unlikely to move the needle. Traders seem relatively assured that this jobs report was unfortunately just not bad enough to warrant another cut, which if you were in the 50 basis points for the year department, you're still there. If you were hoping to see that 50 basis points all in January, the job report today dashed that for you.
Stocks generally seem to be powering ahead despite fears of potentially overvalued AI related stocks and geopolitical risk, the Venezuela situation being the latest. What do you see? Do you see more of the same ahead, or do you see a correction potentially coming up?
I think stocks are going to keep powering higher until something very specifically takes AI off of the track it's on. For whatever reason, although AI stocks are expensive, they're not as expensive as some of the dot-com names were just before the dot-com bust, sort of giving investors some comfort that expensive isn't too expensive, at least not yet. AI is producing regularly producing results, both from a capex and a um, manufacturing return. And the average consumer is actually starting to see some of the benefits of that as now AI trickles through our browsers into our daily life. So there's really not much that's going to take that off unless there's a direct assault on the AI space. But we're also seeing a broadening of some of this rally. We see small caps starting to participate. We're starting to see the signs of this rally has some legs outside of just one single sector. That said, investors should always be ready for that sudden crash because You never see it coming, but when you look backwards, it was pretty obvious the whole time. And your best defense against that is staying liquid and making sure you know what's in your portfolio.